Happy Friday. Happy Friday. It's Friday Facts with the Deluca Group and the Batra Team today. We have a really exciting show today. I would first like to introduce Ian Batra, the team leader. Is that what they call you?
Sure, team leader.
Team leader of the Batra team of Keller Williams Los Gatos. And our markets touch each other pretty much.
Yeah.
And so today we're going to talk about the differences between the market on the Monterey Peninsula and the Silicon Valley, and kind of give you an insight into both markets. And then we're going to bring on Bob Walker from Treehouse Mortgage to talk to you some more about lending and give some, we both have some questions for him. And you can also go to our blog on the website, which will have everything we're talking about will be there. So, first of all, you all know Natalie and Shannon.
Hi.
Leslie DeLuca. And so let's just start by first letting them, ladies, talk about the stats.
Yeah, our Friday Facts.
Their Friday Facts, and then we'll get Ian involved.
All right. So this is covering the last 7 days and all information we get off the MLS here. We had 88 new listings come on the market. So again, that I believe is more than last week. So we're seeing an uptick in sales, which is good for everyone. We had 66 properties go contingent and 41 pending, and 57 properties sold in the last 7 days. Coming up this weekend, we have 277 open houses. So I'm sure there's a property for everyone out there. Go check one out. I'm going to talk about our top 5 picks of the week. So these are the top 5 listings that have come on the market in the last 7 days. Again, we get all this information from the MLS. Doesn't mean that there are listings. The first one, 509 Crescent Street in Salinas. It's a 2-1. It's asking $352,947 square feet on a 6,800 square foot lot. And it has a great backyard for barbecuing, and it's a great starter home in Salinas. Then my second pick is 272 Weber Street in Weber Circle. It's asking $449,000, and it's a 3-2, 1,092 square feet building on 7,800 square foot lot. It's a great starter home. It's very affordable, $449,000. That's a way to get into the market. In Seaside, we have 1290 Wanda Street, asking $450,000. It's a little 2-1, 780 square foot, but on a 5,000 square foot lot. It's got updated roof, plumbing, fence, a manicured yard. It's a very nice property. Another one in Marina, 3158 DeForest Road, asking $549,000. It's a 3-2, 1,500 square feet building with a 10,000 square foot lot. So that's half an acre. That's a lot of property. Large formal living room. It's on a cul-de-sac. It has Brazilian oak wood floors inside. Very nice. Great way to get into the market. Like I said, $549,000. Very affordable. And then last in New Monterey, this one's a pretty good deal. Asking $630,000. 740 Prescott Avenue. It's a 3-2, 1,292 square feet on a 5,000 square foot lot. You can walk to Trader Joe's, to Safeway, to DLI. It's a great location. It's a big fenced-in front yard. Another great starter home in New Monterey. So those are our 5 picks. You can see things are affordable here. Bob's going to talk later again about how to get that loan to get you into that. It's easier than you think. So now Shannon's going to tell you about our event last night and what's coming up.
So I wanted to extend an invitation to our next mixer. We have one every month. We just had one last night, and it was a lot of fun. We had a great turnout. A lot of people had pretty much, I think, all of their questions answered and felt really good about the loan process and are continuing down that path, getting pre-qualified, and that's really exciting. You know, they came in a little bit unsure, and now I think that they've got a good plan going.
Yeah.
So we will be having our next mixer on June 22nd at 5:30, and again, there will always be drinks and appetizers, and it's casual, fun. Come in, say hi to us, let us know if you have any questions. No obligations, just come get your questions answered. This next time around, we will have Bob Walker with Treehouse Mortgage with us, and he will be happy to fill you in and get you on a plan to attain your goals. So we have Bob Walker here with us again today, and he will be having a little discussion here, again bringing some facts to you and filling you in on, you know, what to expect if you think you might be ready to purchase the home. So.
And we'll bring Bob in a minute. I wanted to, this is the interesting fact between Silicon Valley and Monterey Peninsula. So, of course, we have a smaller area. But we had 88 new listings this week. How many did you have?
We had 437 new listings, and our team, we cover the whole Santa Clara County, but our main focus, of course, is in the heart of the Silicon Valley, which is where most of those homes are being sold. So we go from from South County stuff, Morgan Hill, Gilroy, but up to Palo Alto. But really, the bulk of that velocity and those new listings are going to be in the San Jose areas. You know, we do San Jose, Campbell, Santa Clara, of course, a big area where a lot of homes are sold. And the interesting thing on that note is, out of those 437, we had 437 new listings, but we had 440 that went into contract. So
it's the Wild Wild West there.
So what we lost, pretty much for everything that comes on the market, something sells. Earlier this year, we were sitting, for the county, we were sitting at about 1,000 homes for sale. We're up a little at 1,300, but it's been about 1,300 for the last couple months, so pretty much we're totally even. So if a home comes on, it sells. You know, for the stuff that's not selling, there's obviously reasons. Some of it, the price may be too high. Some of the houses just may not be desirable. They may have issues that the homes need to be fixed up. So people are not buying them because they're not ready to move in.
What are your average days on the market? Like when you get a listing?
Yeah.
If you don't get how many offers do you expect in how much time?
Now, it really depends on the area and the home, but recently, one thing we have been noticing is sheer number of offers on homes have been going down a little. So, you know, we've sold a listing every week for the last few weeks, and we, for the Silicon Valley, we expect to sell the home within a week. So what happens is we don't necessarily, we put the home on the market and we sell it when we're ready to take offers. For the most part, as long as it's priced correctly. Right now, because the market has been trending upward, you know, we'll price it and then we'll market it, and depending on the area, we would expect anywhere from 3 to 8 offers. So it's everything we've had recently has sold, but we did have one listing recently that sold with 1 offer. I had another listing that sold with 2, which was down from a little bit of our typical 5 to 8 offers average on our listings.
Wow, and so you would say it's still a seller's market up there?
Yeah, the market's strong. I mean, statistics say county-wide, we were looking at an average price point about $1,080,000. And that doesn't mean that all houses are $1,080,000. There's obviously stuff that sells for quite a bit less, and there's multi-million-dollar properties as well. But if you average all out, we were looking at about $1,080,000 in January. Now we're up to about $1,265,000 countywide. So, and a lot of that has to do with what we're talking about. There's not a lot of houses, and when every home that comes on the market, for every house that comes on, another one sells, or that specific one sells.
Yeah, see, and the other thing that I wanted to talk about, because our markets touch, and a lot of Ian's clients that work up there could buy houses in Prunedale, Watsonville, Santa Cruz, closer to our area, and so Ian can help you there too, because the drive is pretty negligible. It's 24 miles, and our prices are less, and here's why. So where our first-time home buyers would be Seaside, Marina, Salinas, about $450,000 for an entry-level home. How much are your entry-level homes?
So it depends on what area. Santa Teresa is probably the only part of San Jose that's still trending under $1 million. As far as Blossom Valley, average price point's now around $1 million. Then you get up to Campbell, you get up to Campbell, Santa Clara. Those are all averaging $1.2 million plus now. So the other option with a lot of our first-time buyers. I have clients, we had a client of ours, 2 teachers, so put together 2 teacher salaries, and they bought a townhome kind of near the Rose Garden area of San Jose. So there are other options, and that just depends on a preference. So some of our clients say, I don't want to commute, they don't want to drive an hour. for them, you know, it's worth it. You know, they may choose to live a condo lifestyle, go a little more urban, or a townhome, and then they can get into something for they're not going to have to spend $1 million for that. There are options well under $1 million throughout the area, but you know, if somebody does want, you know, they want to be in a single family in the heart of town, you know, at this point now that is going to average $1.2 million plus.
And what is your average income in your area? Do you know?
You know, it really depends. You know, because it's a wide variety of area. Average salaries in the area are now household incomes over $100,000. So actually quite a bit over $100,000. I don't like to throw that as a hard number, because if clients of ours are you know, dual income, you know, husband and wife both work for companies like Apple or Facebook or Google, which is a lot of our clientele, that's going to add up to a pretty large income. Compare that to somebody else, you know, where, you know, where it's only one income, or when someone, you know, a lot of times we have where the husband's a teacher and the wife works for Apple, or vice versa. That's a little bit different. So that actually is part of the thing that contributes to our prices being such a huge wide variety. Couple that with the fact that we almost never have enough houses to sell, that sort of is what increases to our high prices.
And what are you finding with your buyers? What's the average income of your buyers here, would you say? 2 borrowers.
I mean, if someone's looking in the market of Seaside, Salinas, Marina, I would, you know, it really depends, but we were saying, you know, 2 people each making $40,000, $45,000, you know, each, you know, coming in at 80 or 100, you know,
I mean,
around there.
Here, our main industry is hospitality. Theirs is tech.
Right.
Mm-hmm.
And so that's the difference in the pricing too. And they're bigger. I mean, like we had 88, you had
437.
Right. But I just find it very interesting because we're in the same MLS. We're an hour away, not even an hour from their door to our door is an hour, and how vastly different it is. So, but we're still very close, and
that's not even to say here that someone would need to be coming from a dual income situation to qualify for a home, because we've had a lot of single residents qualifying and purchasing homes here. So
right, men, women,
it's not exclusive
retired.
to a dual income situation.
Yeah, that's just. I guess that's maybe typical. We'll ask Bob that question, but is there anything else about the Silicon Valley that you find unique with your clientele?
Yeah, I think, I mean, the Silicon Valley is a very unique place. And what we find a lot of the time is that, you know, people that want to be there, there's a lot, so Silicon Valley has a lot to offer, but because it's a unique place, it's a multicultural place. So for us, it's like our clients that are willing to pay these higher prices, or at least because it's where they want to be. But at the same time, a lot of our clientele are selling their houses and moving out of the area, or, you know, it's quite common for our clients to sell their house in San Jose for an average price point of, you know, $1 million plus, and then they come down here and they can retire into, you know, we talked about Seaside Marina, or depends, you know, sometimes someone sells a much more expensive home and then they buy into Pebble Beach, or they buy into, you know, they buy into Pacific Grove, or parts of, you know, the higher end parts of Monterey as well. So that there are options, and I think, you know, given that down here you get a little more for your money, that is an option for somebody. But for us, it's, you know, the people, our clientele are the people that have a reason and a desire to stay in this open.
And mostly, and that's I have a large number of clients from the Silicon Valley who buy second homes here because it's so close and they can get away from the Silicon Valley and come to the beach and the ocean and be home in an hour. And then they want to sell their houses up there, and then I refer them to Ian. So it's a really great referral source, because I know that he takes really good care of my clients. And what else was I going to say? Oh, darn it. You know me, I lost it. Oh, yeah. Anyway, yeah, the Silicon Valley has a lot to offer. It's very different than here, but we do merge. Oh, I know what I was going to say. Well, for me primarily, I primarily sell on the secondary home market. You guys mostly do primary, and for you it's mostly primary.
Yeah, pretty much. I mean, every once in a while we get a second home buyer, somebody who, you know, I've had some tech executives who, you know, live in New York but do a lot of business out here, and you know, we have one under contract now. We didn't represent the buyer; it was our listing, but the buyer was a guy who lives in Irvine, has a house in Irvine, but he bought a condo, our listing condo at Rivermark, because it's going to be his weekday home. So we do get a little bit of the second home stuff, but I would say, probably 95 or more percent of our business is just primary residences, move-up buyers, downsizers, and first-time buyers.
Yeah. See, and here we have either people who are buying second or eighth homes, or are first-time buyers. So our market here is vastly different. When we have Seaside, Marina, Salinas, which are more affordable. And if you want to be in Monterey, the condos and townhomes, you can get, some nice ones for $350, and then Carmel, Pebble, Pacific Grove, where you go up into the millions. But you can also, there's a darling home right in the Asilomar area that Debbie Beck had listed for $879. It was really nice. It's pending now, but I was trying to sell that to a lot of people. So anyway, thank you. We're going to bring Bob on now. Thank you, ladies.
Right.
And now I would like to introduce you to one of my favorite lenders, Bob Walker. He's with Treehouse Mortgage Group in Monterey.
Well, thank you.
You're welcome. Thanks for coming, Bob.
My pleasure.
Bob has been in the real estate business for many years, and he is not only a lender, but he's been a realtor, so he understands the whole package. And I call him a realtor's lender because he works right with you the whole time, and it's just great to work with Bob. And we both have some questions because as a realtor, I always say that the loan is the heart of the deal. And so if we don't have you and title, we can't do our job. And one of the policies in my office is that we won't even show you a property unless you're pre-approved because it doesn't make any sense. So we have a very strict pre-approval policy at Deluca Real Estate, and it's for our safety, because we need to make sure that you're who you say you are, and that that you're have been checked out, because we don't do that. So if a lender's checked out your employment and all of these things, then we know that you are a legitimate person, because there's a lot of scam in this business as well for us, and safety. How many of you put strangers in your car and drive around to vacant houses? Right? Very dangerous.
I don't.
No. And so also, also just working with a good lender, it's a team approach, and that's what we're trying to do with all of our Thursday meetings that the ladies are doing. Is even if you're not ready right now, Bob's the kind of person who will pull up his computer, show you where you're at, and get you on the right path, whether it's today or next year. And he'll tell you. He won't try to force you to buy a house today. He will tell you, you need a year and do this, 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 and this. And I really appreciate it. It does.
Yeah.
Okay, so this is one of the things I get these people that tell me, well, I have a pre-qual. Pre-quals don't work for me because I know that there's a difference between a pre-qual and a pre-approval. What's the difference?
Yeah, okay. Well, when someone comes to me and says that they'd like to be pre-qualified, usually that's the term that you hear, it means that you're going to be finding out specifics about their finances. We're going to run credit. We're going to analyze their tax returns, pay stubs, W-2s, their income source documentation. That's very important. And we're going to analyze their assets so that we know that they actually have the cash available to close. And in the case of a jumbo loan, that they're also going to have required reserve requirements, which is money that's it will not be used in the transaction. It's actually untouched money, but could be used in the event of an emergency in the future, and it's something that the lenders require. So the difference between pre-qualification and pre-approval in our minds, and we don't do pre-qualifications at our office, we pre-approve people, is the difference that we are analyzing all of the data. A pre-qualification many times can come from just a phone call, where the buyer calls into a lender, the lender asks a series of questions: how much money do you make, how much are you looking to spend, and do you have that in the bank, and what do you think your credit score is? And they base their pre-qual off of a verbal response. And they produce then a letter that goes out, it looks very official, it's on their letterhead, says, Bill and Mary Jones are pre-qualified up to $900,000 with a $800,000 loan, whatever that is, and then it's just open for mistakes. It's open for errors. It's going to waste the realtor's time. It's going to waste the client's time. It's going to set up a false set of expectations, and so you're going to be disappointing people. And so for pre-approval, we're basically going through just what it says, a pre-approval step process. So we're gathering in the credit report and analyzing it. And it's not just the score. We're looking at the whole credit picture. How much debt they have. What's the trended data for that credit report. We are also running that, once we've gathered all that information, we're running that client through an automated approval engine through Fannie Mae or Freddie Mac if it's a conforming loan. So they get what is called a DU approval, inside term. It stands for desktop underwriting. And so we'll either get that through Fannie Mae or we get what's called an LP, loan prospector. It'll give us basically an approval on that file. Now, we could have misinterpreted the information to put it in to get a correct answer, but we've got an experienced team. I have 4 people on my team that are very experienced. None of us are new at this. And so we input it. We haven't had any DU or LP turnarounds where it's not come through. So when we write this letter and we give it to Leslie or Ian to go out with this buyer, they know with confidence that they can go in, make an offer on a property. If it gets accepted, they're going to close. Plain and simple. It takes the guesswork out of the business. It takes the scary part out of the business. Now, Leslie, you mentioned maybe someone comes in and they're not ready. Okay? We've pulled the credit, which is very important to do. If you've got a credit issue, time is can be on your side if you get that process started so you know how to correct and update certain things that are maybe not so desirable on your credit report. We're happy to, we aren't a credit cleaning company, but we've been in the business long enough to know how certain things can be corrected actually by the borrower themselves with a little coaching from us. So that's been a very effective thing. So basically what I'll do is I'll analyze the information, see that you're not ready, but put you on a financial roadmap to get you to home ownership within 6 months, 10 months, a year. And the only people who we find that doesn't work for are people who don't follow the roadmap. And so we have a name in our office for those clients, and we call them renters. Because if they follow the roadmap, 100% of the time we've been able to get it wrong.
It's like if you follow your diet and exercise, you will be healthy.
Yeah, exactly. So, and we want you to be financially healthy. And I'm personally in the business because I think home ownership is the single most important aspect of someone's portfolio for personal financial wealth and well-being.
I agree.
I agree.
So,
So I do have a question, Bob, because one of the things that we've been experiencing, in our business this year is delays in transactions.
yes.
And some, for the most part, we work with professional lenders like yourself. So
Yeah.
on our end, our buyer end, when we're representing buyers, and my team does the vast majority of our buyer representation, but it seems like our buyers are closing on time, but it seems like on our listings we're getting a lot of delays. We had one recently, good sized transaction, $1.4 million transaction, which of course had already fallen out twice for various reasons. Third time we're in contract, it's about to close, and the underwriter goes back in, reopens the file, starts messing with, pulling out things, and it did close, but it closed 2 weeks late.
Yeah.
So my question for you is kind of a 2-part question. What are the things that you're finding are the causes of delays?
Well, that's a great question, by the way. That's a great question because it is the source of stress in our business. Okay?
For
Everybody's
everyone.
stressed out. Seller's stressed out, the agents are stressed out, the buyer's nervous, the
People
loan
have moving
officer's
trucks
nervous.
coming.
Yeah. So it comes up. Why it's coming up is, so we source what are the top things that are causing delay. And I hate to say it, but the number one item that causes things to be delayed is the client themselves. They're asked for a piece of documentation, they're asked for a letter of explanation, and then if we have to wait on that information, we can't move forward until we have it. So, and there's a problem. Sometimes these delays happen at the beginning of a transaction. If you have a 45-day escrow, and there's a lot of delay at the beginning, maybe the buyer has decided to now start shopping for a loan, and they don't commit to signing the disclosures on time. And so they delay the appraisal order or some other aspect of the loan process. That week they waste at the beginning doesn't show up until the last week. It just moves along on the timeline, and so it's always that way. And they've, of course, forgotten that they were the ones that were, in fact, delaying the process of being. So that's number one. The other thing is, this is a complex financial world that we live in. Discovery is what causes an underwriter to reopen a file. They'll ask for a condition, a financial condition. Please explain this on your pay stub, or why was there a reduction in your income from 15 to 16 years? And so those letters of explanation or the documentation that's provided many times can lead to another condition. And then there's that waiting time for the borrower to provide that additional condition. And so that's the kind of thing that happens. There could be an appraisal holdup where the appraisal's done, it's in, it came in at the number, that's great, but then it gets reviewed by an appraisal management company review team, and there's something about it that they didn't like, the way it was processed, or the adjustments were too big, so that can then set you back again. So those are some of the big things.
What I would say is, tell me if I'm wrong, is when we, as a listing agent, when we get an offer and they have a pre-approval letter, we should make sure, like, I always call the lender and make sure that they're really locked in with them, because they do shop the loan a lot of times. They just get the letter to get accepted, and then they shop the loan. That happens a lot.
It does, yeah.
So.
Yeah, and we, unfortunately, because shopping is just part of the business.
Yeah.
I'm pretty, with our clients, we're pretty stern about, be upfront with me. Are you committed to
Your lender.
To the lender you're pre-approved with, or and this is with our clients too. Are you pre-approved? Are you planning to shop around the loan? And if they're and I'll tell them, I'm like, if you're going to shop now,
right.
Because if we're expecting to get into contract, I'm like, you basically got 2 or 3 days, or if you push this out 5 days a week. Now and the difference, another market difference between us is, we tend to do at the maximum 30-day close of escrows. Sometimes we're doing 25, 21. I think in the Silicon Valley, because our inventory's been tight this year, prices are up, it means the 14-day close is making a comeback.
Yeah.
But with regulation changes, we used to do 14. I used to do everything was 14 days back before TRID. And, there's some regulatory changes that made everything take longer. So before the regulatory changes, we were doing 14 or 21 on everything. Well, I've been noticing that I'm getting people calling me on our listings and stuff saying, hey, we can close in 14 days. I'm like, well, is it cash? And then, no, we're getting a loan. So, so with that kind of stuff.
Yeah. So what's happening with that borrower is that they're savvy enough to have allowed the lender to take them all the way through the entire underwriting process before they went out to buy. They're not pre-approved. They are approved. Sure. They have a loan approval. All of their income has been examined. Any questions have been answered. They've got every piece of documentation they need to approve that client. They're approved. Now they need a preliminary title report, which usually a listing agent has already have that prepared.
Sure.
They need to hurry up and get an appraisal done, or sometimes they'll buy it without an appraisal contingency. Although to close, you still need the appraisal.
Absolutely.
So those two items come in, you can close in 14 days. But that's still very, very tight.
Have you? This is something that's happening in our records all the down here. How are your appraisals? Are they coming in quickly? Are they taking longer?
They're quicker than they had been. During the mid last year, there was such a large volume of refinance that was absorbing a lot of the appraiser's time.
Absolutely.
But if you're looking at the market, you see that the rates are higher. It's really slowed. We've got about a 40% reduction in refinance volume. Okay,
Wow.
So the good news for real estate agents is those appraisers are now freed up to react quicker, go out and get the job done faster. So it's gotten better.
And tell the people, like, because people, they have to pay for an appraisal, and they usually don't like to do that. Why do they need an appraisal? Because we understand it, but that we take for granted stuff we know, but people, why do I need an appraisal? And that's, so that's the other thing is I want to educate people. Why should you never, ever, ever check the box that you don't want an appraisal?
Well, I think they're kind of forced to do that, and I think some listing agents have realized that they may be putting themselves into a litigious situation by requiring or inciting that box get checked, that there's no loan appraisal contingency, because it can be it can appear in a court that they were not getting full disclosure. Okay,
Right.
so an appraisal is the eyes and ears of the bank. The underwriter's not going to that property. I'm not going to the property, especially unless it's right in my own community. Many times I do.
Yes.
But it's their eyes and ears, so they have to have that. And for compliance reasons, we cannot close a loan without an appraisal, and we can't pick the appraiser who's doing the work
Anymore.
That's been
We used
eliminated.
to.
That's been eliminated.
We
So
do the business when we could.
it's moving along.
No, I missed that boat.
Okay, well, that was a wild
Okay.
west.
Yeah.
That was a
Yeah.
wild.
So that was-
Call your favorite appraiser
Yeah.
and
Yeah,
ask,
call
tell-
your brother, who's an appraiser, and have it. It used to be joked that the only license a real estate appraiser needed was a driver's license. And it was true. There was no licensing requirement, and it has consistently become tighter and tighter to today what we have now.
Very tight.
So, but it's required. It's gonna be, I feel, even if you got a cash buyer,
I always
the cash buyer should go out and get an appraisal done.
I agree.
Just so they have it in their own hands, so they're not going, whoa, I should have known.
I
you know?
always recommend that my cash buyers, because I do a lot of cash deals, get an independent appraisal, because you don't want to spend too much on a property just because I always say, let's not be emotional about this, let's just be smart. And of course, most people with $2 million are smart. That's why they have $2 million.
Sure, usually people who didn't get poor by accident,
Yeah,
or didn't get
yeah,
rich
yeah.
by accident.
So, but appraisals, that's what you need them, because it's the eyes and ears of the bank, so that you know that you're not paying too much for the house.
Yeah, in our market, we kind of walk a fine line with that one because our market is so aggressive and non-contingent offers are just the everyday norm.
Yeah.
So, I think sometimes buyer's agents, we do a lot of listings. I think buyer's agents, when they're calling me, love me because I'm actually pretty relaxed about accepting contingencies. Within reason. But the reason I'm actually fairly relaxed about contingencies, and I'll explain it to my seller clients, is it's our own liability. Because, I'll tell the sellers, well, what if I want non-contingent? I say, well, if we allow the buyer to have some due diligence, and when they close the sale, then nothing's ever going to come back and say that we forced the hand or we pushed them, we pushed them under duress to buy the property at some high price. But at the same time, on the buyer side, we walk this fine line where we're being pushed back. We don't want to lose our buyer client the property, so in certain cases, but we have to be very upfront with so the way we do it on our team is we're very clear about these are the comparables, these are the properties. We go in strong detail and have them acknowledge, and then it has to be the buyer's choice if they're going to go in and make the non-contingent offer, because it's the way it is. Because otherwise
they have the cash to be able to step up, because the loan is only going to be based upon the appraised value or the purchase price,
Absolutely.
whichever is lower. So if you've got an overbid where it's gotten bid up $100,000, $200,000, $200,000 over the list price, and it appraises only for maybe $100,000 over the list price or at list price, that buyer's going to have to bring in the cash to spend that. And there's some ways to mitigate that. And I think a lot of loan officers miss that. So if you've got an overbid and the buyer doesn't really have a lot of cash to bridge that gap, that's when mortgage insurance can become a very effective tool to allow the loan to value to become bigger. And it's a temporary item that's placed in a loan. It's a great technique that's very rarely used. We do it a lot. You could bring in secondary financing. You can also, now what's coming up, we're one of the few companies that does this, but we have our own proprietary in-house bridge loan. So if you have a home that's tied up not in escrow yet, or it's just on the market, and they found that next house to buy, we can have them borrow the equity from the home to use as a down payment and qualify. Doesn't work for every person, but it is a unique tool that is going to be used more and more. So we're rolling that out. We've had it in the past. We're bringing it back out. We loan out our own money.
Are they expensive?
They are. They are expensive because they're high risk. but they're also very temporary.
Right.
So if you look at the dollar cost of that secondary financing, that bridge loan that's gonna come in to make the deal happen, usually when you look at the whole picture, it isn't an exorbitant expense. But it is a riskier situation, so it's a little bit higher. The rate on it is excellent. The interest rate's 2.48%.
Oh.
So it's a very low rate.
But it's a cost points on the front
There's
end.
just fee points, and then the fees are, there's no payment. It's all built into the deal. So,
I was going to go to the thing. Well, you know, the elephant in the room that I think everybody wants to know about.
Yeah.
You know, and granted, I know nobody has a true crystal ball, but let's just go to the R word, rates.
rates, they're going up. Let's just own that one, okay? Then you'll feel better if they don't go up as much as you think. Rates have marched upward since the 2016 election. Right off the bat, they jumped upward. There's all, we talked about it yesterday at the American Pacific Mortgage Summit. It was a big subject of conversation for us. And, you know, our CEO and the CFO said, look, assume the worst. They're going up. There's all indications that they will go up. I would say probably by the end of the summer we may see some things, and we're already starting to see certain types of files where the loan rates are getting into the fives on certain, you know, less than prime situations. However, you know, I've been doing this since 1990. And up until the time when 9/11 happened, 7% was as good as you were going to get, period. It was like the concrete floor. The rate would come down, it would hit 7 and bounce off and go back up to 7 or 7 1/4, 7 1/8. And we just couldn't get through it until 9/11, and then we broke through that. So you got to realize that rates aren't in the 3s any longer for a fixed rate loan, but 4%, 5%, I'll tell you, we
Anything
will
under
look back
7
in
is
history
good,
and
right?
go, this is, I think right now, we're not at 7, you know.
But anything under 7 is good. I remember
Well,
when I paid
It's
8
historically good.
1/4.
It's historically good, but people have short memories. They want that lower deal. So I think we are going to, I don't think it's going to have a detrimental effect on real estate sales if rates move up slightly and gradually over time. The government is very careful to not let, we're not seeing inflation rise as we thought it was. So that's good, because inflation will cause rates to go up. We are seeing some regulatory things that are coming back on. Privatization of debt may come back. That's what was eliminated in the mortgage meltdown, the privatization of debt. So all the jumbo market was wiped out on August 7th, 2007 at 5 p.m. My world changed.
Mine too.
You know, so I mean, that kind of thing is really coming. We're now offering, we have a product out of the market that's coming out mid-June, which will allow a qualified buyer to buy up to 95% loan up to $1.5 million.
Wow.
Now, will this person have to have good qualifications? Absolutely. But that is now out there. And we have some products that are up to 90%, no MI. And no MI on the 95. So it's some real
They're your
aggressive.
products.
It's our product. It's through another affiliate bank, which is a very hard. They do roll out loans through other entities. We're one of the very, very few. So I can't mention the name of it right now, but it will be rolled out in June. Real exciting stuff. So there's a lot of more aggressive lending that's going to be out there, and as a result, we're going to see some better product and allow for some of these higher prices, because prices, which supply and demand is driving them upward.
And everybody wants a fixed rate, but tell me that if this is true, what I have heard is over the life of a loan, an adjustable, you pay less over the life of a loan on an adjustable, or is that true?
If you went back in history and look back at over the last 20 years, that is a true statement. Now, it has been a lower inflation rate environment, and we went through an economic disaster, right? Everything we did in the early 2000s up to 2007 caused us to have to reset, so we had tremendous loss in our jobs and all that. So rates had to come down to accommodate that. So that caused the adjustable rate loan to be the best buy. Now, if things are going to turn around and we see a long-term projection for higher rates, it's a fixed rate may be a better option. Here's an interesting one that we're going to also be rolling out in June. It's called a 15-15. It's a 30-year loan where the rate is fixed for the first 15 years at a low rate. It adjusts one time on year 15, second month of the second 15 years, one time, and remains fixed to the end of the loan. So it's a double fix. No one else has this product. It's called a 15-15.
Maybe you made this is kind of a spot, so maybe somebody says, what do you say? What's the average time that a homeowner will keep a particular loan?
About 5 years.
So what you're saying? So basically, if someone were to get a better deal on a 5-1 arm or 7-1 arm, most people, you know, I mean, like what are the 5-1s and 7-1 rate at roughly right now?
Oh, 5-1s, you're probably in the high 3s.
Okay. And the 30-year
30-year fixed. Well, if it's conforming, you're probably in the mid 4s.
So you're
4
looking
1/4 to 4.5.
You're looking like maybe saving 0.75%.
I locked one yesterday at 4.125. A real nice product. A real nice. You know, it's rate is what's called an LLP, loan level pricing. It's all risk based. In other words, you and I may get a different rate on the same house, same loan. It's based on credit score. It's based on the amount of down payment, property type, loan to value, debt ratios. There's a lot of things that go into driving the rate. So when people used to call it, what's your rate? We could actually kind of pretty well spit out a number. Now it's, well, what's your rate? I go, well, I don't know. Who are you? You know, I mean, it's kind of that.
That's
You know,
right.
it's based on the
Pre-approval is so
pre-approval is
important.
crucial. So it really is.
So, I would love to have you come back next week if you can.
Okay.
Because, you know, because I know, like, I wish I could Skype you in. But because that's what people are very interested in is rates. And because I have all these other questions about escrow company and stated income loans, and a lot of people hear FHA and VA loans. I know a lot of listing agents are afraid of them. They're awesome. An FHA and a VA loan is no different than any other kind of loan, other than the house has to be decent. And so we've closed a lot of those together.
Yep, we do a lot of that.
A lot of that. So I want to also people that might be eligible for VA loans to explain to you, because he has great products for VA loans.
Yeah, we're the number right now. We're the number 3 VA or FHA VA lender in the country.
Yeah.
We're the 16th largest private mortgage bank in the United States.
And I'll tell you, that's how, for me as a real estate professional, I think I've probably known you for 7 years, but
7 great years.
7 great years, and we've done a lot of business together. And Bob Walker has educated me on the lending side, which makes me a better realtor, because I could sit here and listen to him all day. Somebody just went, because it's so interesting for us. But I'd love to have him come back, and yeah, go have lunch. And if you have lending questions, on my blog, Bob's website is there. You can click on his website to learn all about Bob. But if you'd like to call him, his phone number is 831-236-7826. Bob is just a wealth of information and very, very generous with his time. His email is very easy, bob@treehousemortgage.com. But just go to our, the link is right, the link is going to be right on this email to our Friday Facts. And thank you, Ian.
Thank you for having me. This was great.
It was great. And so Silicon Valley, this is your man, the Batra team. I've known Ian for a long time, and he's smart, he has integrity, he's great. Thanks for watching, and we'll see you next week.
Thank you.